Hey everybody, this is Colin Murphy and welcome to Colin Podcasting About Real Estate, show number 31. So today I had the pleasure of speaking with Mr. Justin Fraser. He's a successful investor, apartment syndicator, multifamily asset manager, host of the True Multifamily podcast. He's been on a fantastic journey over the last few years, and we had a really cool conversation which covered how he began his journey purchasing turnkey single family homes, how he used creative financing and partnering with friends to add additional single family rentals after that, then his big transition into the multifamily space and the very painful and expensive mistakes he learned with that first 40 unit purchase, but how he pivoted afterwards with an experienced partner and went on a huge trajectory, buying 1,000+ units in the last 2.5, 3 years. We talk about the challenges of managing tenants and communities, C and D class communities during COVID, particularly challenging asset class. I think they've done a really good job and they had some great feedback on that. Justin gives some good advice for people that might be nervous about getting started in real estate with inventory being so low. So check out that towards the end of the podcast. A lot of good stuff in here, guys. Justin's been on a great journey. He's been very honest about his mistakes as well as his successes. So I think you're going to enjoy it. Before we head on over to Justin, though, bear in mind that I have a website, colininvestments.com. I'm always tweaking it and revamping it. And more importantly, if you haven't subscribed to my website yet, fill in a form there. One should pop up once you subscribe to it, and that will get you access to the emails I send out generally about once a week, where I have some exclusive videos, content, sometimes investments. So if you really want to hear about what I'm doing all the time with my various investments, make sure you do go to the website colininvestments.com and get yourself on the subscription list, either through the pop-up that appears when you visit or just by downloading one of the reports. That is the best way of keeping track of me. I'm also obviously on social media, either with Colin Investment or Colin G. Murphy. You'll find those on LinkedIn, Instagram, Facebook, etc. So check all those out. We do more than the podcast here, but this is podcast 31. It's a good one, so let's head on over and see what Justin Fraser has to say. Justin Fraser, how are you doing? Welcome to the show.
Hey, Colin, thanks for having me. I'm very excited to be here.
Great. Well, look, let's get stuck in, because I know you've had a very interesting few years in real estate and you've had quite a trajectory. But tell us a bit about yourself, Justin. Where are you from originally? What kind of place did you grow up?
Yeah, I grew up in central New Jersey, just outside of Rutgers, and lived here most of my life and still here for now. And I lived in Philadelphia for a little while. I went to school there, got a job there out of college, and then found a company actually sort of back near where I grew up, and I live about 15 minutes from the town I grew up in right now. So haven't really lived too many other places, and kind of just hanging out here in central Jersey.
Why not? I mean, people love it, don't they? So where did your interest and your passion from real estate come from? I mean, did you start after college working a normal corporate job for several years, or have you been in real estate since a young age, full time?
No, I took a class in real estate at college. I was getting a business degree in marketing and entrepreneurship, and one of the electives I took was real estate, and it was very basic stuff. But sort of on the side, the professor mentioned tax liens, and just the returns that he had mentioned. It was very different from everything else, and it sort of spurred me into like, what is that? Is that legit, or what's going on? And so I started researching real estate on the side in general, and never really got into it. And to this day, never bought a tax lien. But the idea that there were like more higher returns out there sort of sparked some interest in me. But I worked the whole time I was in college, and I got a full-time job before I even graduated. And so I jumped right into my career as a project manager for a software company.
Gotcha.
And I just got really busy with that. But then I switched jobs a few years after I was there for a few years after school. I switched jobs, came back to Jersey, and there I was making more money, and they didn't have as much work for me. So because I was sort of getting onboarded and trained up. But it took like a long time till like the next project came along that they needed me to manage. And so I started researching like real estate and investing, and I looked into Bitcoin, and which maybe should have bought it back then, but all these things I started like, okay, now I'm making some money. I should probably invest. And so I came across real estate. I came across Bigger Pockets pretty
Sure.
much as it was like right around the time the podcast was just coming out, So I was sort of listened every week as the new episodes came out and learned and got pretty excited about it and actually went and bought a single family house in Trenton, New Jersey. And I picked Trenton because that was the only town I could afford in. Trenton, generally cheap, but a good cash flow place. And so I put traditional loan, went to Bank of America, put 25% down, and bought a rental property.
Did you have to fix it up, or doesn't sound like you needed a
So I
lot if
was
you're able to get
deathly
a Bank of
afraid
America
of
loan?
contractors and deathly afraid of like all these things I did not know about. I just had heard stories about people getting ripped off, and I knew nothing about renovation or construction. So I bought a turnkey house that was totally fixed up. Trust me, I went through a lot of houses that smelled terrible, that were terrible, that, if you step too hard, you'd probably fall through the floor. But this house was turnkey, ready to go, ready to move a tenant into it. The woman that lived there, her son was a contractor, and he had kept the place really nicely for her. So for me, it was great. I could just buy it. I think I bought it within a week. I had tenants in there, so I didn't have to do anything to it. Yeah,
it's a nice way to get started. Not too dramatic. So it sounds like your passion for real estate just kind of came organically from your university teachers and from you noticing Bigger Pockets and other stuff. So you didn't really have other family members or uncles or whatever that were buying rental houses that could kind of show you what they were doing.
Well, come to find out now, I find out like back in the day, my dad had rental property and my uncles all had rental property, but nobody ever talked to me about this, not until I was doing it. And they're like, we used to do that too, right? I'm like, nobody ever told me. So maybe that would have changed things, but I don't know. But I found it, without family input or anything like that. And, that first deal was pretty interesting for me because going into it, I bought it as, look, this is something that'll, pay for itself over the next 30 years that I pay down the mortgage, and it'll be a nice supplement, when I retire. And almost immediately when those cash flow checks started coming in and I looked at what this property was doing, I was like, man, this is awesome. I need to do more of this, right? This property is making me money. This is a cash producing asset.
What year was this that you bought your first house, to give us a little bit of context?
This was 2014.
Okay.
So
so you're well past the Great Recession and all that. You're into the kind of recovery mode where prices are still cheap, but
well, pretty much since that day, everyone's been talking about when the market's going to fall out and real estate's going to go down, and so I've been waiting basically since I started buying houses. But I figured, why wait? Jump right in and see what happens. So I figured I was going to be holding long enough that even if prices dip down, as long as the deal was cash flowing, and it did cash flow really nicely, that I'd be okay.
Yeah, no, and I remember talking to people in 2013 and 14 that were telling me I'm going to wait for them to fall again. I mean, goodness, they've been waiting a long time, haven't they? I mean,
well, how much wealth would you have missed out over the last 6 or 7 years?
Yeah, absolute fortune. So, okay, so you bought a rental in 2014. You're still working in a good kind of software manager job. So did you just buy another couple after that once you saved up the down payments again?
Well, I put all my money into that house, and I didn't. My interest was greater than the money that I had, so that forced me to figure out creative financing and partnership.
Okay.
So I brought a friend on as a partner who had a little bit of money, and we bought another house, but then he was out of money. So we had to figure out how to do seller financing, how to find private loans. We flipped a house using all private loans, private money, and we basically had everything into our houses that we had as far as spare cash. And all the
How did you structure that second deal? Did your friend put up most of the money and you just took on the ownership and the mortgage together, or
we formed a company together? We formed a company together, and it's basically set up where when that house sells and we're actually under contract to sell it, he'll get his initial investment back, and we split everything on top of that 50-50, because I was bringing more of the knowledge and experience, he was bringing the money, and it worked out.
Okay. So yeah, and you run up, a lot of people run up against that. They put their $20,000, $30,000, $40,000 down payment, get their rental property. Oh, this is great. I like this. I can see the rental checks coming in. Let's do another one, but don't have another 40,000 lying around. And that's how you, so what did you do? So you formed a JV with your friend who had a bit of money, then you bought a second, and then your friend is in the same boat as you. Said, well, I've given you the money I had. I don't have another down payment. So what did you do next?
Right. That's exactly right. I think the next one we did was a flip, and
Okay.
we thought, okay, let's generate some more money so we can go buy some more rentals. Let's flip a house, and
Sure.
we'll use private money. So we had we used 100% private money from a friend of mine, and we made every mistake that you can make flipping a house, except we bought it right. So we paid the right amount for the house, but I mean, just over improved, just put way too much time and energy and money into it, had the wrong contractors on site.
Uh-huh.
It took us 2 weeks shy of a year to flip that house,
Wow.
which is very expensive and in a very
It's
long
a long
time.
time. Yeah.
But at the end of the day, my private lender, I think made like 25,000, and we made like 20 to split. So we made less than the investor. That's okay. But then we were able to sort of bring that in and use that for some money for the next house. But we also then got a little itchy. We wanted to go buy more houses while we were flipping, and so the third house that we bought, we used private money. So we just, again, not seller financing, but another friend of our family member, actually,
Mm-hmm.
he set it up. They were going to pay for 100% of the cost. This was a house that was $60,000 in Trenton, so it's not too
Okay.
much. So they funded 100% of it. We knew it was going to rent for $1,250, and so we could make that payment
Wow.
super easily, and we did, and that worked out well for us.
And was that what was the term of that loan, or were they just happy to give you a 10, 15-year loan, or was it like a 3-year loan or 1-year loan where you had to refi out?
It was a 3-year loan, actually, but interest only. And
Nice.
since they're friends and they're making their money back, we actually still have that one, and it's just cash flowing, and we just keep paying them auto payments every month. And we're not buying down any of our equity, but we are cash flowing pretty nicely, and thankfully the market's appreciating for us. So we just
So you could easily refi out of that now if you wanted to.
Yeah, we could, but we don't need to because it's cash flowing, and they're happy with the return that they're making. I think it's 8% or something like that. Yeah,
That's very good. Yeah, on that kind of lower cost property with a strong cash flow, 8%. Yeah, we'll do that all day long.
absolutely.
So you did a handful of single family homes. You're kind of stretching your creative muscles a little bit, and then I understand you made a much bigger transition into multifamily, right?
Yeah, so I was hosting a RIA meeting, and just started running the meeting in my town, and my now partner, Matt Faircloth, came and spoke about a 49 unit that he had just bought. And Matt, active in our area, and wrote a book for Bigger Pockets. I think this was before he wrote the book, though. And so he came and was talking about this 49 unit that he had just closed, and he broke it down step by step for our audience. And I thought, man, I can do that. Like that sounds great. We were struggling trying to find, this is probably like 20s, end of 16, 17, that we're now like, deals are drying up. It's getting expensive. Everything is much more expensive. It does not cash flow the way that they had just a few years before that. And so I figured, why I'm spending all this time and energy looking for the next $60,000, $70,000 house. Why don't I spend this energy looking for a multi-million-dollar place? And so didn't exactly know how I was going to do it, but the way he broke it down made sense to me. And so I figured, let's go buy an apartment building. So he set a goal to go buy a 50-unit property, and it took me about a year to learn that industry, to learn how to evaluate deals, to learn how the money works, how to syndicate a deal. But I put together a pretty solid plan, and that's a year from sort of that inspiration, that day of inspiration, to the day that we actually closed on. We bought a 40-unit property, and so I was
Where was that located?
That's in Virginia. So I bought that. I drew an 8-hour driving range circle around my house and said, okay, anywhere I can drive to during the day in one day seems like a good spot to buy a property. Knowing I was still working, knowing I was having to take vacation days to get there, to evaluate properties, to meet people. I figured I didn't want to fly. I just wanted to be able to drive there in one day.
Okay.
So I was looking from here in New Jersey. I was looking up in Syracuse and Western Pennsylvania and down into Virginia. And so I found this property from a broker. And
was it like on LoopNet or
was not on LoopNet? So the first few I looked at were on LoopNet, And I made relationship with a broker down there in the Hampton Roads area. And I think 3 or 4 trips I had gone down there, looked at properties with him, and they just weren't penciling out. I mean, made a few offers, but the numbers weren't working. And so I really wanted to be conservative on my numbers. I really want to make sure it was the right deal because I had never raised that kind of money from people. And so we brought in, he called me, I think on a Thursday. It was like, hey, this just came up. It's, we haven't marketed it yet, but it's everything you've been telling me you want, except it's 40 units instead of 50 units. Value add deal, needs money, needs repairs, room in the rents to go up. And so I was there by Monday, and took vacation days from work and ran down there, and it was a good deal. And so I held firm on my price. We negotiated for a while, for like 2 or 3 months, but eventually the seller came around and we got it under contract. And then I had to go through the whole process of finding investors and doing the due diligence and the underwriting and the whole mess top to bottom.
So the seller put it under contract and negotiated with you for several months, even though you didn't have the kind of proverbial proof of funds at the time.
Yeah, so exactly. So part of my challenge was that I didn't have any sort of experience in properties of that size. And so
what purchase price are we talking about here?
$2.25 million.
Wow, yeah, a lot of money.
40 units, $2.25 million, right? So the largest property I had bought at that point was probably that flip that I did. So in the like $250,000 range, right? So nowhere,
we're
talking order of magnitude, exactly. So in the early stages, when I started looking for these deals, I wanted to go look at a 96 unit and 110 unit, and the feedback I was getting from the brokers was like, who are you? I can't take you as a strong operator to a seller and say that this person is going to be able to close because you have no experience. So I approached Matt, who had come and who was that inspiration about his 49 unit. And I said, look, we've known each other for years. I'm going to go do this, but I need your credibility. I need you to lend your experience to the team. So instead of me and my 3 units, it was us and our 200 plus units, right? And
gotcha. Brilliant.
That he had. And so I was happy to give up as much equity as I needed to give up, fees, all that, just to get my foot in the door. And so together, I was able to then go, still doing everything I was doing, but I was now representing us instead of representing me. And so it gave just much stronger presence to who was making that offer and who had the experience and all that.
Brilliant. So you brought on basically a more experienced partner. You did a JV with a local guy who'd been there, done that you knew personally, and he lent you his name. And presumably then was it like a 50-50 joint venture, or did he take a lot more because you were still so new to the whole thing and you're just happy with a smaller amount?
Well, we still have to syndicate. And so we had there's a lot of points of negotiation here because he was willing to lend his experience, but we wanted to be very clear on the time commitment and also the financial commitment. And so we settled on a non-financial commitment, meaning he was not going to sign on any loan documents, and he was not going to bring cash to the deal, which allowed me to keep more equity and more control. He was simply lending his name and had some oversight in what I was doing, basically trusting me with his name on the things that we were submitting, the offers we were submitting and all that. So more of a mentor, oversight, support, less of a
kind of consultancy fee type deal.
Yeah, essentially, but still obviously very, very active in the making sure we're going to execute the business plan.
Okay. And so how did you go about raising the money then? So you clearly needed to raise how much did you need to raise from syndicators?
I needed to raise $660,000.
And then the rest will be financed with a commercial loan.
Correct. And so I did. Thankfully, everyone at work knew what I was doing. They all know I was the real estate guy, and I had talked to a bunch of them about funding the next flip or the next rental. And so when I got into apartments, they were sort of on board. My boss actually ended up being one of the investors in our deal. Brilliant. And which is a great alignment of interest, by the way. Like when you say, "Hey, boss, I got to go check on our property," like Yeah, okay, here's a vacation day. Go ahead and do what you got to do, right?
Keep an eye on my money. Yeah, that is. I love
Exactly.
that.
Yeah. But also, since I was running the local meetup, there were a lot of people there that, trusted me and I had great relationships with. And we would get, 50 to sometimes 100 people at this meetup. So there's a lot of people that knew me, and I did a good job of keeping in contact with them and letting them know what I was up to. And so they trusted me. And so we were able to raise it in about 2 months.
That's brilliant. Well done. And so you raised it 2 months. And what was the pitch? I mean, was this like telling people this is a 5-year play till we get it up and running and refi it, and then I'll pay you back, or were you keeping them on board as long-term equity partners?
So long-term equity partners, the goal was going to be to buy it, fix it up. We put $300,000 into the deal. We had to renovate all the units, replace all the HVACs, and increase rents. And so the idea was, year one's not really going to cash flow, but after that, we'll be able to kick out some nice cash on cash returns. And then when we sell this thing around year 7, you get a nice check at the end with all the increased equity.
Yeah. Okay. And
Yeah.
that must have been, so you're doing a lot of heavy lifting here, kind of finding the deal, finding the partner. You'd obviously done a lot of early work in kind of putting yourself in a position where you could pitch to investors by setting up the RIA. And then now that you get the deal, you got to find contractors to fix up 40 units. That's another mountain of work, right?
Yeah. Not to mention, this property is 6.5 hour drive away from my house as well. So it's not like I'm there every day. And I had a lot of contacts in the market, but it's not the same as being there and living there and all that. So I'll be honest, I made a lot of mistakes early on in this deal, and one of those big mistakes was hiring the wrong property manager and general contractor.
Wow.
And
Yeah.
I thought we had a good team in place, and I was buying what they were selling, and it just ended up not working out. And so they just did not have the experience at this type of level of property. They had a lot of experience in like the 12 unit type property that just did not translate to a 40 unit. And records were unclean. We weren't tracking what we were spending, where it was going. Units were sitting vacant for far too long, and overall just made a lot of mistakes, and probably did not pull the plug as quickly as I should have when we started noticing some problems on both the PM and the contractor. So I freely admit that, and bring my investors along for the ride, and they know, and I own up to the mistakes that I've made on that. It took us a long time to sort of recover and get back to that. But it's one of the hardest things is to find the right people on the ground to support you with your property. That's really the most important thing, I think, is who on the day-to-day basis is representing you to the tenants, to the local community, on behalf of your property.
Yeah. So and it's so hard because it's like you say, every community could be in a totally different city, town. So you can't just find one great manager the way I can find a great person in Northwest Tampa and they can just do all the units up there. I mean, you're buying something in Virginia, you're buying something in wherever, Trenton. I mean, you're different company every time almost, right? Certainly when you're at that 40, 50 unit level. So was it you just kind of fired the original manager and found another kind of local manager, local contractors in the area once you'd been through the ringer with the first batch?
Yeah, I mean, we really slogged our way through it for about a year, and the contractors finished up most of their work within that year. So we got most of the renovations done, thankfully. The property manager was tough. Actually, I'm friends with the owner of a management company up here in Jersey and Pennsylvania that was looking to expand, and so it was sort of serendipitous that they were looking to expand to a new territory. And I had this need down there, so I was in their ear about, hey, come to Virginia, and was able to link them up with another property manager down there. And so they were able to come down and expand their business and take over my property as part of expanding their business. So this was someone that I trusted and know, and it really worked out that he was growing his company, and I was able to get a manager that could handle my property.
Yeah. Well done. So tell us the good news. So you bought it for 2.25 million. You spent what, 300,000-400,000 on it?
Yep. Yep.
What do you think it's worth now? I mean, cap rates are a little lower than they used to
Well,
be.
cap rates are lower. We're actually in talks right now and trying to figure out our best path forward because of the way the market is. Uh, I'm actually been speaking to a broker who's valuing it at 3.1, which is
Uh-huh.
awesome. But we also are at a point where we could refinance into some really great long-term low rate debt and
Yep.
cash flow for a while. So we have some good options in front of us. And frankly, I'm putting it back out to my investors and see what their appetite is. They wanted to get in for 7 years. It's only been 2.5.
Okay.
So if they want their money back out and they want to sell, then I'm kind of okay with that. And if they want to roll it into a new loan and cash flow for a while, I'm good with that too. The challenge is that's the only property that I have in that market. And so what I found in the years since is that focusing in on specific markets, growing your portfolio there has been really, really helpful. So now, we'll get to it, but I own a lot of property in Kentucky and in North Carolina. And it's just so much easier when you're visiting a property to hit all your properties in the one state or the one town. And that's sort of the outlier. And it's also being a smaller property at 40 units. It's tough to manage. Expenses are high because I don't have full-time property managers. It's still a third party. I don't have full-time dedicated staff. And so
Yep.
we do struggle with that a little bit. So
A
we
lot
have
of
some
people.
options.
Uh-huh. So a lot of people after doing the few houses and the flip and then the 40 unit kind of baptism of fire, you might have been licking your wounds for a while, maybe buy another 30 or 40 unit a year later or another 40 unit a year after that. But you're not that type of guy, Justin. So 2.5 years ago, you bought the first 40 units. How many have you bought since?
I'm over 1,000 units right now.
It's amazing.
So yeah, so it's been a busy 2.5 years. So that was May of 18 that we bought the 40 unit, and in September of 14, there were layoffs at my company. So everyone from the vice president on down at my team got the axe. And so my first thought was, that initial panic of, I need a job, I need to go find something else. And thankfully, my wife, really talked me off that ledge and said, look, we're okay. By the way, I had my second baby on the way. So I was like really thinking I need cash. But we mapped it out and we said, look, we've got a good 5 months of runway before we are feeling any heat and you need to start looking for a job. So why not take 4 or 5 months and see what you can do in real estate? Because that's what you enjoy doing. I had already been making plans to leave my job. I probably would have taken another 2 or 3 years. I'd probably still be there, honestly, because you get addicted to that check that comes in every day.
Yeah.
But every other week or whatever. But she said, take your time and figure out what it is you really want to do. And so I started hanging around the office. So Matt's got a co-working space, and I was hanging around, and there's a bunch of real estate investors there, and trying to figure out what I was going to do. I really thought I had to go buy another 40, 50 unit property and get that next acquisition fee and get more fees coming in and cash flow and all that. But sort of just serendipitously, Matt was going to North Carolina. He had just bought a 200 unit property, and I was like, hey, let me come along, learn, hang out a little bit. And we got down there, and he went one way and was like interviewing a property manager. And I went, on the way down, we had talked, and I said, let me help. So I'm like negotiating with one of his contractors for him. And, we both sort of realized like there's a nice fit here where I can run a lot of the day-to-day, the asset management, and Matt can go, be Matt, be on Bigger Pockets, have a YouTube and all that other stuff. And so very quickly it evolved into, I am now the asset manager for the group, which gets me equity and fees on that project. And it was awesome because there was a role for me on that team that was needed, which Matt and the rest of the team didn't really realize how much of a need there was. Everyone was sort of just trusting the property manager, and that was not, working out for everybody. So I'm able to come in, be the asset manager, be the person who is running the business plan for that property, holding the property managers accountable, holding the construction team accountable, making sure we're spending money in the right places, making sure we're getting the returns and measuring occupancy and all of our other KPIs, and really becoming responsible for the execution of that business plan. And so very quickly, that was the end of 18. In 2019, we bought 3 properties in Kentucky together. And so I sort of fell right into the team and joined on as a partner. And we bought, 400 units or so in 2019.
Wow.
And sort of really cemented our role together. And
are you still tapping into your RIA people or your ex-work colleagues to raise money, or were you more on Matt's side of things to do that?
Yeah, so Matt has a great network and raises the bulk of the money. We sort of broke this down into there's different roles. We call it the multifamily bus. Everyone's got a seat on the multifamily bus. And so for me, my role is asset management. Yes, I will raise money for our deals, but I'm not looked at as the guy that's going to save it, by what I raise. I might bring a few $100,000 to each of our deals.
Gotcha.
But really my role is writing the business plan, executing the business plan, making sure those properties work well, getting the construction dialed in, making sure due diligence is on point, making sure that this project is, what we want it to be.
Mm-hmm.
So that sort of evolved through 19, and we bought properties and we're renovating, putting a few $1 million into each of them. Lots of construction happening, lots of, looking for that next deal. And for all of 2020, we really spent 2020 looking for the next property, and given COVID and everything, it was hard, but we actually just recently closed on our largest purchase yet, which is a 336 unit deal in North Carolina.
Oh, nice. Congrats.
Thank you.
How was it? It must have been pretty stressful back in March, April, when everybody thought the real estate world was going to end and people were going to leave apartments in droves, and high unemployment was going to cause mass, defaults on rentals, and thankfully didn't happen like that. I mean, but your rentals, were they more, I've read that the rentals with more white collar people have been a lot more steady, but the blue collar tenants that might work in kind of bars, restaurants, hotels been obviously much more negatively affected. What kind of mix did you have in your projects, and how did defaults spike?
We buy C-class assets in C-class areas, and we fix them up, and or maybe they're D-class assets, really. I mean, we've over the last 2 years perfected the art of buying something that has crime and issues in terms of collections and mismanagement, putting in a strong property manager, putting police presence if necessary, like doing whatever we have to do to get out the tenants that are causing trouble, and bring in some quality tenants that want a nice place to live. And so the properties that, when we buy property, it's not all about renovating units and getting a higher rent, but we actually invest very heavily in the community aspect. We put playgrounds in all of our properties. Okay. We have a soccer field that we built, grilling stations, dog parks. I mean, for the rents that we're getting, we usually have the nicest amenities in the market. We want to be the property that every other tenant in that market wants to go live in, right?
Yep.
Because of all these extra amenities, they want to stay as well. So we try to set ourselves apart from the competition that way, and we invest where probably some other owners wouldn't. But that doesn't mean we didn't have some challenges this year.
Of course.
But it's really property by property. I mean, thankfully, yes, in the beginning, everyone sort of threw up their hands and said, "We don't know what's happening," and there was a lot of panic, and we didn't know how to respond, except to just keep doing what we're doing. Just keep turning units, keep providing service, keep taking care of work orders, keep taking care of our tenants, and let's see what happens. And what we found is that almost all the tenants want to pay rent. There are a few exceptions. We have found that some can't because of loss of job, and those who can't, we work with. And there's a very big difference between a tenant that comes into the office and says, I'm trying, I want to do this, I want to do that, and a tenant that just does not answer calls or emails and does not open the door when you knock.
Sure.
And so the tenants that don't answer the door and don't answer emails or the phone, those guys, we have to be creative with, if they're not paying. We do have some tenants that have not paid since February. And there's really not much at this point, given where we are in December 2020, there has not been much we can do for those guys. except file that eviction and wait until the courts open up to process it, right?
Yeah.
And at some point that'll come due for them. But the tenants that we are working with, which is the vast majority, we help them with support. There's been a ton of support from local agencies, especially in Kentucky. We've had a lot of great support from the city there and all the agencies that are, we file the paperwork. The tenants are getting their rent paid for, back rent, forward rent. I mean, in some cases, 90% of the rent for months and months and months. So it is requiring more work. It's requiring another level of care and attention to the tenants from us, both ways, really. But we've been doing mostly okay. We did suspend distributions on all of our properties when COVID first hit. I'm happy to say that one of our properties, we did a double distribution. Like, we paid twice as much as we needed to for the preferred return, because the property's just been doing so well. And the others, each one is a little different, but we're taking care of our tenants and our investors the best we can.
Okay. How do you see, like everybody, if you've got a crystal ball there, you know exactly what's going to happen next year.
Absolutely.
Where do you see, how do you see these projects doing next year? We're kind of at the beginning of the end, vaccine going out, but the economic situation is definitely not as clear cut. What's your take on the multifamily real estate market in 2021?
I mean, for us, because we are so committed to buying right, we actually, the last few months have all been record collection months for us, and they keep getting higher and higher. And that's not because we still have record past due balances, I will say, but our business plan is to renovate units and increase occupancy. And so by increasing occupancy and still putting in quality, good tenants, we're still bringing in enough positivity to sort of outweigh the negativity. And so, the eviction ban is scheduled to end in a few weeks. Whether that happens or not, or gets extended, we don't know. We're preparing for all different scenarios. But what I do know is that I'm still collecting more and more rent month over month, because I'm continuing to turn units and I'm continuing to implement my business plan, and I'm continuing to add value to my tenants or prospects, which is encouraging new people to come in. We're trying to be creative and in some instances doing cash for keys or getting out the non-paying tenants however we legally can, and we're following all the rules set by the city, local government, federal government. But we're doing okay. And so at some point I'll run out of occupancy, right? We'll fill up all the units and we can't increase that way anymore. And then it's a matter of keeping a very close eye on money coming in, money going out, who's delinquent, how we can work with them. Can we forgive a past due balance? If a tenant, let's say they extend the eviction ban another 6 months. Well, if I have some tenants that are in the property that haven't paid in a few months, maybe I'm willing to forgive a few months of past due if they can show me that they can get back on track, right? Because I'm never going to get October's rent at this point, right? That's just, there's no way anyone's ever going to catch back up for October, November, December. But if something changes with that tenant and they're willing to work with us and they're answering the phone and they're coming to the door and they say, look, I can make this now and I can make January and February's payment, but I can't pay the past due, I'll probably work with them and forgive a past due balance, so that I'm thinking for the best interest in the long run.
I understand that. And do you see yourself getting better deals next year or the year after, or do you see this continuing to be a very competitive market for acquisitions?
I think it's competitive. I mean,
I know I'm in the single family home space, and it's ultra competitive at the moment, especially
I don't
middle class properties.
I think for those who know what they're doing, who are buying right, it is a competitive market. There's still a lot of interest. We just looked at one where we thought we'd be at, I don't know, call it like 16 or 17 million. We might be able to stretch to 18. And so I was looking at it, and broker called and said they got an offer at 25.
Wow.
Like, okay, great. Good for them. That's not going to be a deal for us. So, if it was a softer market, we might have, pushed at 19 or 20 for that one, but they're getting multiple millions over asking. Then, I mean, it was a class A market, but and a great deal, but so it would have been a stretch for us. But there's a lot of competition. We stand out because we've closed. When we say we've never gotten under contract and not closed and not performed, and we have a lot of track record and experience now. So hopefully we stand out from the competition. But there is a lot of competition out there,
Yeah,
even on
but at
that
least
big
your experience will prevent
space.
you from doing something, silly, overpaying for properties, which some people will. But I guess you just
That's
have to be patient.
that's why we
You
went
have a
most of
good portfolio.
2020 without buying anything, right? Our
Hmm.
June of 19 was our last major acquisition. We didn't close until October of 2020. So over 12 months, we're happy to be patient. We're happy to wait for the right deal. It has to be the right deal because for me, being responsible for asset management, right? We need to buy it right because now the acquisitions guys, the capital raisers, like all that work is done when you close. My work is just beginning. I'm the one that has to run
Yeah,
this thing for the next 5, 7, 10 years, depending on the business plan. And if we start, behind the gate by overpaying, I'm not going to be able to get the returns for our investors, and we're just going to be struggling the whole time. So we're very particular about the properties we buy, and you have to be.
yeah, I agree completely. So, considering we're in kind of a competitive market, whether it's multifamily, single family, what have you, I mean, what advice or suggested starting steps do you have for people that want to get started now, or want to accelerate creating wealth through real estate? What should they do? What should they avoid doing?
Well, you got to do it. You got to get in the game. And I tell everyone, it doesn't matter what you think about the market. Like we said at the top of the show, right? People were talking about being on top of a market back in 2014, 2015. So
Hmm.
don't wait because you think you have a crystal ball and you know what's going to happen next. Buy right, buy for whether it's cash flow or appreciation, whatever you're buying for, learn the fundamentals, make a business plan and execute the plan. And so stick to your guns, stick to knowing, you want to stretch a little bit, but not to the point that you're putting yourself or other people's money at risk or unnecessarily at risk. And bring on
Yeah.
partners. I've always been a fan of bringing on people that are more experienced than me, smarter than me, happy to
Hmm.
give up equity, equity for your first. No one's going to get rich on their first deal, right? Even you're going to go buy your first 50 unit or whatever, you're not going to get rich off of it. It's going to set you up if you play your cards right, meaning you use that as a stepping stone to the next and the next and the next, right? I will make more from this property we just bought than any of our other deals combined, and probably the next one even more and more. And so that's a long play. That's a years in the making, right? It was fine for me to give up equity to mentors and partners and whoever I had to give up equity to on my 40 unit, knowing it was positioning me for the long run to have that experience so that I'll make some money down the line.
Hmm. Yeah, that's brilliant advice. I love it. And I totally agree with you that it is, people do sometimes overthink things for the first couple of deals, waiting for everything to be perfect, perfect price, perfect margin, perfect renovation, perfect street. And you wait forever for that. There is a lot to be
Absolutely.
said for just doing it, getting the experience. And like I said, don't set yourself up to lose a fortune on your first deal. But if you do a ton of work and just end up breaking even or making 10,000, that's not the end of the world at all. You've learned a lot that'll set you up for third and fourth and fifth.
Absolutely.
Yeah, well, brilliant. I've really enjoyed this conversation, Justin. There's a lot of good stuff in here. I mean, before we finish up, any great books that you've read recently, or useful tools that you could recommend to our listeners?
Yeah, I mean, tools. We're all about the tools, and I'm trying to systematize and process everything. Been a big fan of Traction, and just that entrepreneur operating system, and how do we systematize and processize everything. I've just brought on a second virtual assistant, and I'm just trying to work out all the process and playbooks so that we can go buy another 1,000 units and another 1,000 units and not have it feel like I've got to work 500 hours a week, where
Mm-hmm.
I can hand this off to the right people. So I'm taking what we're doing. Even now, I always have that mindset of what I'm doing now is the test case and the stepping stone for the next. So I'm trying to document and process everything that we do. So I do a lot in Excel. We do use a cool tool called Smart Sheets, which is basically Excel that with some nice workflow functionality, and you can build in dashboards, and so I can report KPIs on one tool, and it automatically feeds to a dashboard on the other tool that our
Uh-huh.
investors and our partners can look at. And it's very helpful. It gives us a good insight into what's happening
So
at all of our
Smart
properties.
Sheets,
Smart Sheets.
SHEET.
Yep. Yep.
Okay,
Yep. So
that's interesting.
that's
I'll check that out.
yeah, it's nice. It works for us pretty nicely. So.
Well, brilliant. And it looks like so tell us a bit more about how our listeners can find out about you. It looks like you're active. I see a cool banner in the background there. You're active in the in the podcasting space. And it seems like there's a bunch of ways for people to reach out to you.
If you're watching, there's right here all the great ways you can find me. But the most prominent is my podcast called True Multifamily. And on True Multifamily, sometimes I have a guest, sometimes I'm speaking just real life stories about managing our multifamily properties, all the mistakes we make, the wins, the losses. It could be a cool story about how we added a ton of value, or it could be, how I hired the wrong property manager and set myself back for a year. I mean, there's really just open, honest, the sort of stuff that, you hear on podcasts. Everyone sort of talks about raising money, finding deals, pop that champagne, and everything was fine. But I like to dig in on what happens after we close and all that hard work that goes into making sure our properties are performing well. That's what we talk about. And I've had some really great guests that just share some really awesome open stories. And, it really helps for me to learn from other people's wins and losses. And frankly, I love when our guests come on and share some hard stories, because that helps all of us learn so we don't make the same mistakes.
It does. Well, thank you for sharing your victories and your mistakes with us, Justin. I've really enjoyed this conversation. Thanks again.
Yeah, thank you, Colin. Appreciate it.
There you go, folks. That was Justin Fraser on Colin Podcasting About Real Estate, show 31. I hope you enjoyed it. I certainly did. I always really enjoy speaking with multifamily people. And I'm a single family home person. I've got some small multifamilies that I own, but they're only 2 to 4 units, and I've kept a few of those. I've sold a few of those. I've done hundreds and hundreds of single family homes, but I'm always slightly in awe of people that buy hundreds of properties at once. I mean, it's such a different product, and I'm really appreciate the skills it needs to manage that business, manage all those moving parts. It is proper asset management when you have 100, 200, 300 unit community, or the bigger people that have many of those communities scattered around multiple different states. That does require quite an impressive skill set. So I really do enjoy talking with people like that and talking with people like Justin. And it just goes to show that, it isn't all kind of grizzled veterans that have been doing this for 20, 30 years, although those obviously exist, and some of the most successful people are in that category. But you take a guy like Justin who, 4 or 5 years ago was literally only on his kind of second or third single family rental, which a lot of our listeners will be on that same path. And he made that huge jump while working full time, from owning a handful of single family rentals to buying a 40 unit, to figuring out what's going on and how to get it right, learning from his mistakes, working full time and kind of going back and forth to this place that's 8 hours away. So he really did put in a lot of sweat equity, let's say, into that deal. I love his initiative that he showed by setting up a local RIA. And again, it just goes to show you don't need to be the most experienced person in your area to set up a RIA. A RIA can be set up by anybody at all. You can be a total beginner and set up a RIA and still attract experienced investors that are keen to network, that might not have your ability to set up a RIA, using social media and using whatever tools you've got there. So don't be afraid to set up a RIA if you don't have a good one in your market. As you've seen from Justin, that worked out fantastically well for him, because he was able to tap into that network to borrow some money to fund his first deals. And that was, again, another baby step to moving on to bigger and bigger things, where buying a 40 unit was a huge transition. Whereas now, like I say, he regularly looks at 250 to 300 unit deals in the $20 million range. So it's really amazing what you can achieve in a few short years if you're prepared to put in the work. And of course, if you've got a very supportive spouse, which was clearly his case. So yeah, I hope you can take some inspiration from that, and certainly take his advice that it's never a bad time to start, that there's no reason to sit on your hands, to sit on the sidelines just because we're in a weird time right now, that inventory is low, that prices are high. It's never too early to learn. It's never a bad time to learn. So, and you really only learn by doing in real estate. I mean, you can read all the books you want, and it's important to learn. It's important to do your due diligence, and it's great to partner with people that know a little bit more than you. But you really only learn anything worthwhile in this game by doing it, by actually buying something and just rolling up your sleeves and figuring things out. And the first deal doesn't have to be a home run. It can be break even, it can be a small loss, doesn't matter that much, as long as you don't lose your shirt, but just use it as a stepping stone for the second, third, fourth deal. And keep going. set goals, keep going, see where it goes. It's a journey, right? So thank you again for staying in touch. If there's anything I can do for you, just go to the website, colininvestments.com. You can schedule a quick 20-minute call. I also do 1-hour video Zoom calls if you want to dig a little bit deeper into what's going on in your real estate life and your business life, and any advice I can give you to help with that, I'm happy to. I also teach people about foreclosure auctions. I do believe there's going to be quite a significant increase in foreclosure auctions in 2021 and beyond. So if you want to learn a little bit about that, just reach out to me as well. Other than that, thank you for your support. Don't forget to give me a rating or a review if you're enjoying this content and haven't done so yet. If you can share a link on social media with your friends and family, I would also greatly appreciate that. But that's all from me today, I think, guys. This is Colin G. Murphy signing out. Thanks again for listening. Take care. Bye-bye.